Welcome to another session of RM Smart Investing. Thank you very much for being with us. Our today's class will be in different types of charts. Most of us are very familiar with the candlestick charts and bar charts, and I thought it would be timely perhaps to get us more familiar with some other types of charts that some day traders and professional traders use that they feel gives them the advantage. So before we start introducing the different kinds of charts, I just want to make sure you are familiar with what the charts are really based on, and they contain. Majority of charts are dependent on price, time, and volume. So these are the three major elements in any chart. Now, what we're going to talk about is we've seen the price, time, volume, but there's a combination of different ways of looking at charts. So that's why we will spend the next half an hour or so to get more familiar. What are the other charts? So the first one is the most familiar one most of us use, that depends on time and price with the overlay of volume. So we use the volume as a really secondary to help us to understand the power of the charts. And the main ones that we use is the candlesticks, which is the Japanese chart pattern and type. And most of in the Western world, they use the open, high, low, close bars. We call them Western bars. You also have lines, you have areas, histogram, and Hakinashi, which is really developed from the candlesticks, which is a kind of a momentum trending candlesticks chart pattern. So, and we will discuss that. Now, what I'm going to do today, I'm just going to introduce you all these types. We have had classes on, for instance, on candlesticks. We've had the classes on Hakinashi. We will have classes on, as well as in other types that I will be introducing. So again, today is just an overview so you can get more familiar. Now, as I mentioned, majority of you are familiar with the candlesticks, which is really, it's a 17th century Japanese style, which was the rice traders used to use. And for me, it's my favorite actually style. I use it a lot because I'm very visual. So it's very much, it shows you the body is the opening, the closing, and then the tails that you see, for instance, they're the low and high. So today, again, I'm not going to spend too much on it because you're familiar. As you can see, this depends on the price. You can see the price on the right, and you see the volume, and the time is your selection. For instance, for now, I will be spending all our charts will be on SPY, which is the S&P 500 ETF, the spider. And basically, this is a daily chart. You could have a 60-minute chart, you could have a 5-minute chart, or you could have weekly charts. So you can see, you can choose your time, and based on that, you can have your chart. The other type that, again, in a Western world, a lot of traders use is that the open, high, low, close bars. And it is, you can see it's similar to the candlesticks. You can see that the open, the close, the low, the high visually. So it's easier to see. When it's dark and black, basically that means it is going, it's positive, the buyer's in command. And then when it's red, that means it's going down. Most of the time it's the seller's in command. So it is very similar to candlesticks. In candlesticks, usually if you have a green candle, for instance, that's the same as the black candle here, a black bar here, which is that's positive. And if it's red candle, or it's a reddish candle, in then, or sometimes it's filled black candle, that is negative in candlesticks. So basically, again, the same idea. You can choose your time, could be minutes, could be weeks, could be monthly. So you can choose, and based on that, again, you have the price and the volume as well. Now, we also can just look at something called the line, and the line basically just focuses on the close of the price of the underlying asset. Again, we're looking at the SPY. Again, we have the price, we have the volume, and in this situation, again, it's the spider. It's at the daily charts. We could have a monthly, we could have weekly. Now, one of the things we can use this for instance, is let's say in the mutual funds. As you know, like mutual funds is only one price. It's the close of the day. They do not trade during the day. So the line makes more sense because they don't have a high, low, close, open. None of those are applied to, let's say, mutual funds. So that's why this looks more pleasing if you're doing a mutual fund. And you can see again the red most of the time. It represents the distribution, and the black represents the accumulation or the buying. There are some more, depending on the charting platform that you're using. There's the area, sometimes like mountains. So you can, again, the volume, the price, and basically I've had a 50 and 200-day moving average in all of these, so you can get more familiar with from that point of view where they stand. They're all the same, so comparing. And again, you can see it's like a combination of the lines and lines, and the next one is a histogram. So again, the histogram is a different charting and graphing, but it's the same principle. You can see the close, and when it's red, it's distribution. When it's dark gray, it is again that's visually tells you that's accumulation. So you can see where we stand. It's easier, pleasing to see the support and the basically actually the resistance, for instance. So and you see these little shade, that's the volume. Again, it all depends on how visually you're oriented. The last one is one of my favorites, actually. This is Hakinashi. And basically, Hakinashi comes from the candlesticks. We do, as I mentioned, we have a video on this if you'd like to get more in depth. It is very useful, especially in a momentum trending kind of investing and trading. So this basically lets you know if the trend is going to continue. And basically what it does, it combines the previous two candles, or it combines two candlesticks, and based on that creates the candlestick. So for instance, when it's hollow in this situation, that's positive. That means this candle is higher and the price has broken out. So the momentum is changing. We like that. After the two, if it's red or it's filled candles, then that says that that trend or this situation distribution has stopped. This is a good time, confirms that we can go, and especially if you move above the, let's say in this situation, 50-day moving average, you have a lot of power, more momentum to continue this trend. So that's Hakinashi. And as I said, there's more in-depth videos on this. So far we talked about mainly it's the time and price. Again, with all of these, you can choose what time period you want to use. There is other types of charting that they actually emphasize on the volume and the price. And so they kind of marry them together. And what happens, there are some people who don't really care about volume, but there are times that the volume is really the fuel of any move. It's the gas in the car. So it's important to have that energy. So basically now, if you're interested in to see if there's any movements, for instance, if there's a breakout, you want the conviction. If there's any distribution, you want to see how much of activity was there. So there's basically four types of that they are more popular of the volume and price charting. And those are the ones that I felt might be helpful. The first three are really combining the price with the volume in one bar or one candle. And that's all three of them. They're developed by Richard Arms, from the famous Arms or the trend that you're familiar with. So he came and suggested that, okay, we are visually can see things. We can see the price went up really high or went down low, but was there enough power behind it? So basically, as I mentioned, he marries the price with the volume. So the price which is in this case is the high, I mean the low and the high of the price per day. That's the height of this candle. And what you can see, the width represents the volume. So the wider the width, the more volume it is. And when it's red, that's distribution. And when it's black, that means it was accumulation. So the volume was positive, the price was up. So in this situation, what you can see, again, you can see that the price moved up. It was good volume. In this situation, the price moved down and it was a good size volume. Now, when you have really thin candles, but thin bars, actually, these are bars, that you see that there were not a lot of volume. So sometimes the movements are suspicious. When do you have these like really narrow and small bars, then that means that, you know, it's suspicious, there's indecision. So just be careful with that. These represents actually the bigger the bar, it can help you a couple of things. Number one, it gives you where is a good support, for instance, and again, there's a lot of volume. So the bigger the block or the bar, the more support or resistance will be. And then it also tells you again if there's enough movement and there's enough power in the movement of the price. So in this situation, again, visually we can see the only thing is that equal volume is basically it is the high and low of the price. So he kind of tried to use something else. We call it candle volume. So he's marrying the candlesticks with the volume. And in this situation, as you can see, that here we do have the high and low. The width is the volume. And again, when it's red, it is that shows that that was distribution. And we actually can see the body of where was the opening, where was that closing. So if I compare that to the previous candle, you can see that was hollow, big red one. And here is like really a very thin body here. So he went one further and decided to say, well, let's call it arms candle volume. So now I've married the equal volume with the candle volume, and we call it arms candle volume. And here you actually have the high, the low, the body of, and then you can actually see where you stand. And again, if you're visually oriented, this is pretty interesting, especially if there's like a breakout, you want to see, was there any conviction? Was it a big volume coming in? So if you're volume oriented, this is, again, pretty good. This one with the time, actually, you can actually have it daily. You can have it 60 minutes. You can have it on 10 minutes. So these are really good that you can, again, combine, but emphasize more on the volume. And the previous one, we were all on time and price. Here, visually, you can marry the volume with it. The last one is called volume profile, and volume profile now is like almost a bell curve. So we have the volume usually on the bottom of your chart. So this is also called market profile. Basically what it tells us, and we will have a class on this, so you have much deeper understanding. In general, what it does, it tells us, for instance, this is a daily chart of S&P ETF, S&P 500 spider, and it's a yearly, 1 year, and it goes and tells us what price we've had the most activity volume wise. So it goes back and looks at that time period and says, well, in this situation at $434.79, this has been the biggest activity, the most volume, and that's called point of control or POC. And then they look at, again, when we look at the bell curve, or we talk about one standard deviation, we say about 68% or 70% of the time, what other prices have had the most activity or most volume. And based on that, you can see there's something like this is produced. And what this does, this area, for instance, is the value area. And it tells us that 70% of the time, S&P spend most of its time there, volume wise. So a lot of activities have happened. So you can basically, you can use them as a support and resistance. So you can see where we had a lot of activities, and when we go outside of that, usually that means it's going to come back to the mean. So it's almost like the expected move. So this is we've done it upside to the side to show the volume. Now, as I mentioned, we will have class and we can have the volume for 60 minutes. We can do it on 5 minutes. We can overlay it over the price, but that's for another day or another conversation. So far we've talked about the price, we've talked about time, and we've talked about the volume. Now, there's some day traders, there are some actually swing traders that they really feel price is the only factor that should be considered. And they look at the order flow, they look at, we call it transaction by transaction, to see where the power comes and how much this momentum has legs. So basically, they are really just focusing on price only. And there are quite few of those. There's the Renko, most of you might have heard of Point&Figure, the Kagi, there's range bar, there's a Kase, 3-line break, and then at the end is ticks. So basically, all of them have a very similar principle behind it. So all they say, we don't care how long anything takes. What we have a predetermined movement. Let's say it's like $1 or 1 tick or 10 ticks or 1,000 shares. All we want to know, we want to see how much of that movement, which way is it going? So basically, if there are, for instance, if there is a $1, every dollar will represent 1 block, 1 bar, 1 line, it will seem Point&Figure like X and O's. So each one of them will represent one thing, and it's regardless of time. So it could be, we call it like maybe time agnostics. They don't care about time. Basically, that's all they care is what it takes for this price to move. So that price take, if it's on a day, it might take 10 days or it might take 30 minutes. So they just want to see that the movement and where is that order flow. So let's use some examples. So the first one I use is, again, this is a 1870s, again, Japanese style, kind of similar to Candlestick in a way, but this one, as I mentioned, it doesn't look at how much the time is going to take. Basically, they look at each candle, each bar here, and sometimes the brick, and they look at it and they assign a value to it. For instance, the Renko is very good in like day trading. So if you're momentum oriented, you want to see how far this momentum is going to continue. And I will show you one example totally. Now, on a daily, for instance, if you use like S&P daily, be using every bar represents $3.50. So you can also use, one of the ways you can use is like an average true range to assign. You could have said, I want $1 moves, or I want to use $2 or $3, or in this case, $3.50. So every one of these is $3.50. So as long as we are moving at $3.50, this block continues. The minute there's a reversal, we are down $3.50, then this bar changes to a red, and that means distribution. So now if I have targets, if I want to take some profits, this visually I can see that this is a good time actually to get out. And then if I want to short it, I usually maybe can use a 2-bar confirmation, and then you short it till you have a reversal again. The other good thing about this, you can visually see things, we can see the double bottom if you kind of another clean double bottom, but you can see that, you can see resistance, you can see easier to see the trend lines. So basically it's very clean in that sense. So that's very similar to in the Western, what we come up with the Point&Figure. And Point&Figure, all it says is, again, we assign a value, and using again the spiders, and we say for every $4, that it moves, we put an X in that block. So if it doesn't move, if it moves less than $4, we just stay in that block, and that's an X. If it goes beyond 4, now we are moved to the next block. So as long as we keep moving, then we will continue. And then what you could say, if we drop, let's say 3 times that or 2 times that, that's the reversal. And when that happens, then we are done with this movement, and now we can put a O in there, and that shows distribution. Now, the good thing about, again, with the point and figure, again, there is no time. We don't care how long it takes. As long as there's a movement on the price, it will continue. So it is interesting to see that development of, let's say you have the triangles, and we can see the resistance. If we break above this, we can actually use the trend lines and basically supports. So it's visually, it's purely on the price. So you don't see the volume, you don't have the time. All you know is, for instance, this is where we are. And then, you know, you can see the support at 432 and 428. So basically there was a resistance. Once we broke above the 448 at 452, it continued. Again, you can choose what amount is your movement. So based on price again. You also have Kagi. It's very similar. Again, we assign this, in this case, again, we're using the 350, the average true range. And basically, this is, again, from 1870s, the Japanese traders, they were looking at these thick lines, they're black, as when we break above the resistance, the color changes to the dark, to a thick black. That means there's a positive, there's a momentum coming, and it will continue till we break the previous bars. The price will, in this case, again, we're using the 350. When it goes below that, it changes to thin red. And again, visually, you can see the supports and resistance. And again, the trend is more pleasing. So all of these, they have the same theme. They are regardless of what the time does, even though we have the times here, but they're not equal. So basically it doesn't matter. We just work on that 350 movement. The 3-line break is also similar in a sense that we talked about Renko. Here, again, the movement continues. Whatever assignment we've had, let's say you did $1 or $2, and if it's $1, it will continue till we have the reversal, and the reversal is the red, which is the below of the 2 previous bars. So we always go back to 2 previous bars. If we break below the 2 previous bars, then that's distribution. Be careful. Now you can see we didn't have many. Visually, you look at this on SPY and you see, wow, there haven't been many. And that gives you, again, the trend of the market keeps you in the position. Again, most of these, like for instance, I mentioned Renko, they are very good on a day trading. You can basically, to make sure you're on the right side, and make sure that you are going with the momentum. I have an example here. So what I did, I decided to put all 6 of them. This is on, basically, again, we had no time. So this was after hours, as you can see. And basically, I'm using 1 tick on the S&P futures. It's only 1 tick. So every movement is based on that 1 tick. So we have the 3-line break. If it goes up 1 tick and continues 1 tick, so we just go. And then if it drops half a tick, we don't do anything. And then we start a new one, 1 tick, 1 tick. And then we have 2 ticks, we go below these 2 bars. And when we go below that, then that's red. And when we go above these 2, that's green, and then we broke again. So it's visually, again, you can see, you can stay in your position. The same thing, for instance, with the Renko. Renko, if I'm using half a tick, so you can use half a tick. And when we talk about the tick is the smallest amount of movement per underlying asset. So for instance, in S&P, we use 0.25. So that's the tick. For instance, in majority of stocks, they usually, even the liquid ones, they move by 1 penny. So it's the smallest increment that something moves. So here we use half a tick. You can use 1 tick. And then the same thing with the S&P point and figure, we're using 1 tick. So it's a lot of movement. If you use 2 ticks, this will not be a lot of noise. So it will be a little more orderly. Again, this was actually closing of the market at that time, and these are after hours. I went a little further, so a little different. You can see this as far as like the range bar and Kaseya is, they are very similar. Again, the range bar, that tells you each bar. Now here we talked about, we use like 1 tick. Here we use each bar represents 1 tick. And basically these are good to see the trend. And again, like they say, it's like a channel. It's a lot smoother and easier to see how the market is moving and see the support reversals. And each one, again, these are telling you the open and the close, and basically just give you that range. So, and here you can do the same thing with candlesticks if you wanted to combine both. Last but not least is the tick bar, and tick bar, I use it, and usually in a very, like in scalping, you can use it, and each tick, especially during the day, the markets really move fast. So if you want to wait for 5 minutes, especially in a heavy orders or the order flows, the transactions are very high. By the time you want to catch the reversal, or you want to see if there's a breakout, sometimes it's too late. So we use the ticks, as I mentioned. Each bar represents the number of the ticks. So for instance, this bar is a 233 ticks. So if the ticks are in this situation the smallest movement, what we look at is every 233, that every time the S&P went up, this is the futures, up and down, we look at the movement. So when there's like filled 233 of them, we move to the next one, we move to the next one. So in like candlesticks, let's say we use the time, we say, well, 1 minute, that's 1 candle, done, let's go, open, close, that's the next one, next one. This one, you just fill that bucket with 233 ticks movement, we move to the next one. So 512 is a little slower than 233. So you can go as slow as, like, if you want 1, but that will be a lot of noise. But I usually 144 will be the lowest I go usually. You can go 87 if you want, but 233 and 512 has worked. They have worked well with me. And also you can add indicators. So the point for now is not talking about moving averages or stochastics, or we're not talking about MACDs you can add, but you could, and that will give you confirmation. So right now, this tells you, again, the movement is after hours, but before the hours, it's very fast. So basically, that's what the tick bar is. So I finish it with the one more segment. This is something different. It kind of, there's other charts that you could use. One of them is the Alexander Elder's creation, in a sense. He had something called Elder impulse system. So basically what he has done, he's a big proponent of MACDs. So what he's done, he uses the colors of, if we are above 13 EMA, which is an exponential moving average, and the MACD is positive, if once we break out, the color turns green. So that's his confirmation to go long. When there is a contradiction, in the sense that we are above, but the MACD is going down or is selling, that's neutral, that's blue. And the red is when we break below the 13 moving average and MACD is down, that's distribution. So that's called Elder impulse system. So that's one of the ways, again, you could use it if you like. The other one is the performance, and a lot of, again, you want to see, you just want to see how your position has done, and you can use this to compare different assets. If you're using FANG assets, for instance, or if you want to use international exchange traded funds side by side, you can use the performance and say, oh, you can see that the relative strength, which one has been stronger? What is the tendency, the trend? I mean, we can see, for instance, this is the EFA, which is the Europe, Far East, and Australia, for instance, how they have done, and they're up like 12.58% year to date. So this is called performance chart. And the last but not least, I thought this was really interesting. You just don't care about the bars or other things. You just visually want to see, let's say you just add moving averages with no bars and just look at it and see cleanly if they're converging, if there is they have run away from each other. For instance, we've talked about, let's say 20 or 21 period moving averages. Sometimes it goes so far away from their 200-day moving average. If that happens, visually you can see and say, well, eventually that's too far away. They have to converge. So this is something called invisible, and that's come from stock charts, so you could use that. With that in mind, I hope that was informative. Again, this was an introduction, just give you a little heads up. Sometimes you see these things on your platform and you say, I don't understand it, so I'm going to ignore it. But sometimes you might think that based on your personality, this might work best. So again, in my situation, like for instance, I really like Candlesticks and Hakinashi. That fits my personality with the visual, and I like to follow that. Basically, some people really like Point&Figure. They just don't care about the volume. They don't care about, again, the time. They just like to see visually where are the breakouts and the resistance and the patterns. And so I hope this was useful and helpful. And with that in mind, I again thank you very much for being with us. And with that in mind, I like to wish you a prosperous and happy trading. Thank you so much. Bye now.